In the macroeconomy, the total expenditure should be equal to total income. You earn income, then you can spend. Therefore, if you use expenditure approach, the nominal GDP number you get should be equal to the nominal GDP you get from the income approach. So next, let's talk about the income approach. Who has income? The answer is whoever produces has income. And who produces? That is, what are the production factors? You have learned this in your microeconomics. Labor, capital, land, and entrepreneurships. These are the production factors. They produce and therefore they earn income. So the aggregate supplier's behavior is that they produce. They are production factors. So income approach is from the aggregate supply side. Look at the behaviors of the suppliers. Now, let's sum up the income of all those four production factors. The labor's income is wages, salaries, or called compensations for employees. Capital's income is the interest rate, the interest. If you borrow money, you have to pay interest. You borrow money to buy machines. Therefore, the income for the machines, for the money you buy, is the net interest. Land's income is called rental income. Entrepreneurship's income has two parts. The first part is if the entrepreneur is corporated, then the company's profit is the entrepreneurship's income. For those entrepreneurs, they are not corporated. Say, for example, you open a restaurant. Then you are called a proprietor. Then proprietor's income is another part of the entrepreneurship's income. Therefore, you sum up these five parts, it will be the total income in the economy. However, to get to nominal GDP, you have to do two adjustments. Why? Because the sum of those incomes is just the net domestic income at factor cost. That is, the money we pay to the production factor. The money, the income that production factors earns. Say, for example, bread in Meijer, remember, it's $50, right? But do you pay Meijer $50 to get a bread? The answer is no, because actually you pay $50 and 6% sales tax, right? Therefore, you pay $50.30. So the market value of the bread is $50.30. It is not $50. So in order to get nominal GDP to include this 30 cents, you have to add the sales tax to the factor's income, to baker's income, to farmer's income, to miller's income, to Meijer's income. You have to add this 30 cents, which goes to the government. So you have to add sales tax to the factor cost in order to get nominal GDP. The government not only tax you, but sometimes they subsidize the companies or subsidize the consumers. So subsidies is just like a negative tax. So the net tax will be indirect tax, that is the sales tax, minus the subsidies. That will give us the market price, because the market price is $50.30. It is not $50. The second adjustment is that you have to add the depreciation to get gross domestic product. That is, in macroeconomics, gross is defined as net plus depreciation. Why? Well, you drive a car. Your car gives you some production, some contribution. You pay your car loan interest, right? So your cars earned income, and that income is the interest you pay to the bank. However, your car contributes more than the interest you pay to the bank. Why? Because it depreciates, and you didn't take that into account. Therefore, to get the gross domestic product from the car, you have to add the depreciation. Say, for example, from this chart, this is your initial capital. And your capital works, your machine works, your car works, and it depreciates. This is your gross investment. But when you look at this, the total capital becomes this, and it is this much more than this. But this is just the net increase. You have to add the net increase and the depreciation to know that this is the total contribution of your capital. Therefore, for income approach, nominal GDP should be equal to labor's income, that is compensation for employees, plus capital's income, which is net interest, plus land's income, that is the rental income, plus the entrepreneurship's income, which has two parts. The number one is corporate profits. The second one is small restaurant, the proprietor's income. And then you have to do two adjustments. That is, add sales tax and then add depreciation. So when we use the income approach, you add up labor's income, capital's income, land's income, entrepreneurship's income, you get the net factor cost. Then you do two adjustments, add sales tax minus subsidies, then that will be the net domestic income at market price. Then you do the second adjustment, add back the depreciation. The result is 14,399. Remember, using expenditure approach, the number we got was 14,579. So there is a statistical discrepancy of 180, which is very small compared to the number. Therefore, the income approach and expenditure approach give us two numbers that are very close. So the calculation is correct. Now remember, our goal is to define the variable on the x-axis in the aggregate market. And we want to introduce the most popular measure of the quantity of the aggregate market, which is called real GDP. That's our goal. But so far what we have learned is called nominal GDP, because it's easier to understand the nominal GDP. With the understanding of the nominal GDP, now we can learn how to calculate real GDP. So what is real? Okay, real has a special meaning in macroeconomics. It is not actual, like in English. Okay, let me give you a very simple example. What do we mean by real apples? If we have one apple, the real apple is one apple. And what is the nominal apple? Nominal apple is the market value of this apple. Say for example, the price of apple is $1 each. Then the nominal apple is $1 times one apple, which is $1. But real apple is the real thing, not the nominal money value. It is one apple. So this is real and this is nominal. Say for example, let's make the macroeconomics easier by assuming that in the economy there is only one market. So we turn a macroeconomics question into a microeconomic question. So suppose that the economy only produces apples. In 2005, this economy produces one apple, and the market price of the apple is $2 each. Therefore, nominal GDP is the market value of all the productions in this economy within a specific period of time. So nominal GDP is the market value of this apple. The market price is $2 each, and we only have one apple. Therefore, the market value of this apple is $2. Therefore, nominal GDP in this economy is $2 in 2005. Now, in 2010, this economy produces two apples. And the price of apple goes up from $2 to $3. Then what is the nominal GDP in this economy? The answer is we produce two apples and the market price of apple is $3 each. Therefore, the nominal GDP, the market price of all the productions in this economy is $6. So nominal GDP is $6. But the real production in this economy goes from one apple to two apples. So the real production doubles. Real production doubles. But if you use nominal GDP to measure the real production, it goes from $2 to $6. It triples. Therefore, you cannot use nominal GDP to measure the real production. Then, what can we do to measure the real production? That is, we don't want the number goes from $2 to $6. We want the number to go from $2 to $4. So that is doubled. So we can use it to measure the real production. So we want the number to go from $2 to $4. How can we do that? Thought. How can we get $2 to $4 instead of $2 to $6? This one is nominal GDP. But for real production, real GDP, we want this number to go to 4, not 6. How do we do that? The answer is, if you assume that the price of Apple doesn't change from 2005 to 2010, that is, if the market price is still $2, then 2 multiplied by 2 will be 4. That's what we want. And that's how we calculate real GDP. We pick 2005 as the base year. Okay? The value of apples in 2010, remember, how many apples? How many apples are produced in 2010? 2, right? If we value that 2 apples at the 2005 price, which is $2 each, then we get the number we want. Therefore, we say the real GDP in 2005 is the same as the nominal GDP. We defined it in 2005 dollars. And real GDP in 2010 in 2005 dollars, use the same price, is 4. Then real GDP doubles. That is, real production doubles. We produce from 1 apple to 2 apples. So if you calculate real GDP that way, real GDP doubles, just like the real production. Therefore, in sum, how can we calculate real GDP? Well, we fixed the price. Assume that the price doesn't change because we don't want the price to change the number. So we use 2005 dollars, 2005 prices to evaluate the value of the production in both years. In 2005, we produced 1. In 2010, we produced 2. So you multiply by the same price, the number will double. Alright, with that understanding, let's make the example a little bit more complicated. That is, we introduce another good, another market into the aggregate market. Now, this economy produces apples and oranges. In 2005, this economy produced 1 apple and 3 oranges. The price of apple is $2 each. The price of orange is $1 each in 2005. In 2010, the production of apple doubles, but the production of orange decreases. And the apple becomes cheaper, but the orange becomes more expensive. Alright, did you see that? 1 good is very different from 2 goods example. Now you have 2 goods. How can you measure the real production? In the 1 good example, you can say it goes from 1 apple to 2 apples. The production doubles. But here, can you say production doubles? No. Orange is less. You have fewer oranges. even though you have more apples. That is why we need this way of calculation of real GDP to measure the quantity of the aggregate market. Okay, but the basic principle is the same. How do you find the changes in real production? Again, you assume that the price doesn't change. So you assume that in 2010 the price is $2 each for apples and $1 each for oranges. That's how you do it. So what is the value of 2005 production, value at 2005 price? Well, what is the 2005 production? 2005 production is 1 apple and 3 oranges. 1 apple and 3 oranges. 2005 price, apple is $2 each, oranges is $1 each. So the value of 2005 production value at 2005 price is $5. So we say real GDP in 2005 is $5. In 2005 dollars. Now, what is the value of 2010 production? Value at 2005 price. Remember, we don't change the price. What is the 2010 production? 2010 production is 2 apples and 1 orange. And you want to value it at 2005 price. So what is the price of apple in 2005? The answer is $2, not $1. And the price of orange in 2005 is $1, not these $2. Then we get, again, 5. So the real GDP in 2010 is $5 in 2005 price. Therefore, according to the definition of the way we calculate real GDP, the real production in this economy doesn't change from 2005 to 2010. This is the old method of calculating real GDP before 1995 in the United States, and some of the countries today are still using this old method. Later, we are going to introduce the new method of calculating real GDP in the United States right now. But this old method is straightforward, so it's easier to understand. That's why we introduced this old method first. So the old method's idea is you value each year's output at the price of a base year. So you pick the base year and fixed the price level at the base year. In our example, we use 2005 is the base year. And real GDP in 2010 is the value of the goods and services in 2010, but you use the price in 2005. That is, you assume that the prices in 2005 had not changed from 2005 to 2010. Why do we do that? Because remember, the purpose of calculating real GDP is to measure the quantity of goods and services, the variable on the x-axis. So we want to calculate the quantity. Therefore, we do not want the price to affect our calculation of quantity. We just want 1 apple, 2 apples, 3 apples. We don't want to know the money value of the apples. Therefore, we fix the prices at the base year. Therefore, here, the definition. Real GDP is the value of goods and services at constant prices. That is, we don't change the prices. Now compare real GDP and nominal GDP. It's clearer. Real GDP, again, is the value of goods and services at constant prices. So we value all the goods and services in different years using the same prices. Then what is nominal GDP? Remember, nominal GDP is the market value. So it is the value that you currently see in the market, the prices that you currently see in the market. Therefore, goods and services in 2005, you have to use the prices in 2005 to calculate the market value. Goods and services in 2010, then you will have to use prices in 2010 to calculate the market value. So it is the current price. Goods in 2005, use 2005 price. Goods in 2010, use 2010 prices. Now, let's go through another example again. This time we have 3 goods. So this is an example in your textbook. Say in 2003, this economy produces 3 goods: T-shirts, computer chips, and security services. In 2003, this economy produces 3 T-shirts, 3 chips, and 5 services. The price in 2013 is $5 for each T-shirt, $10 for each chip, $20 for each security services. In 2014, this economy produces 1 more T-shirt, that is 4 T-shirts, 1 less computer chips, so only have 2 chips, 1 more security services, so 6 security services. The price of T-shirt doesn't change. The price of computer chips increases by 10, from $10 each to $20 each. Price for security services increases from $20 each to $40 each. Alright, now first, let's calculate the nominal GDP. Remember, nominal GDP is the market price, market value, is the market value. So what is the production in 2013? Answer? The production in 2013 is 3 shirts, 3 chips, 5 services. Then what is the market value of the production in 2013? The answer is 3 T-shirts, the market value is $15. 3 multiplied by 5. For those 3 chips, the market value is $30, $10 each. For those 5 services, the market value of these 5 services, is $100. Therefore, the market value of these productions is $145, which we called the nominal GDP. Now, in 2014, what is the 2014 production? Answer? 4 T-shirts, 2 chips, and 6 services. Then what is the market value, the market in 2014? What is the market value of these productions? The answer is $5 for each T-shirt, so it's $20. $20 for each chips is $40. The market value of 6 security services is $240. Therefore, the market value of these productions is $300. And we call that nominal GDP in 2014. Next, we calculate the quantities, the production of 2014, but we want to value the production at the 2013 price. That is, now our base year is 2013. We want to choose 2013 as the base year. Now we want to calculate real GDP. Well, first, what is real GDP in 2013? Real GDP in 2013 is the 2013 production valued at the base year price. What is the base year? 2013. Okay. So what is the value of these productions valued at this price? The answer is exactly the same number, right? That's how we calculate the nominal GDP. Therefore, in the base year, nominal GDP is equal to real GDP. In the base year. Okay, so the real GDP in 2013 is $145 in 2013 dollars. Now, how about the real GDP in 2014? It will be the production of 2014 valued at the base year price. What is the base year? 2013. What is the production in 2014? The answer is 4 shirts, 2 chips, 6 services. 4 shirts, 2 chips, 6 services. But we want to evaluate 2014 production in 2013 prices because we want to value them at the base year. Therefore, we use $5, $10, and $20 to calculate the real GDP, which is 20 plus 20 plus 120, which is 160. That is the real GDP in 2014. Therefore, using 2013 as the base year. So in 2013, nominal GDP is equal to real GDP, which is $145. And 2014 real GDP is $160. Therefore, real GDP goes from $145 to $160 from 2013 to 2014 if we use 2013 as the base year. Then what is the growth rate of real GDP? That is, what is the growth rate of the production of this economy? Well, this is how you calculate the growth rate. It is the change, or growth rate is equal to the percentage change. Okay? So when you go from 145 to 160, how much is the change? The answer is the change is 15. Then what is the percentage change? Percentage change is the total change is 15. Change from what? Change from 145. So you divide it by 145. Again, percentage change, the change is 15, and change from 145. Therefore, the growth rate is 10.3%. Use your calculator. Now, the question is, can we use 2014 instead of 2013 as the base year? The answer is, why not? There's no rule saying that we have to use an earlier year as the base year. We can use the 2013 as the base year. We can use 2014 as the base year. If you are using 2013 as the base year, you use 2013 prices. That is, you ignore 2014 prices. If you use 2014 as the base year, then you use 2014 prices and ignore the 2013 prices. So now, let's calculate real GDP by using 2014 as the base year instead. Again, the way to calculate nominal GDP is the same. Now, we want to evaluate 2013. We want to value the 2013 production at the price of 2014. That is, now 2014 is the base year. Okay, remember the base year. In the base year, we use the price in the base year to calculate the real GDP. Therefore, what is the production in 2013? Again, the answer is 3 shirts, 3 chips, 5 services. Then what is the production in 2013 valued at the price in 2014? The base year. The answer is 3, 3, 5, and then we use this price. That is the production of 2013 valued at the prices of 2014. The answer is 5, 3, 5, 3, 15, 3, 20, 60, 200. The answer is 275. So this is the 2013 real GDP. Now, what is the 2014 real GDP? The answer is 2014 production. What is 2014 production? The answer is 4 shirts, 2 chips, 6 services. Value them at the base year price. What is the base year? 2014. So it's exactly this one, and this one. So again, as you can see, in the base year, the calculation of nominal GDP is the same as the calculation of real GDP. Therefore, in the base year, real GDP is equal to the nominal GDP. In the base year. Therefore, in 2014, base year, nominal GDP is equal to real GDP. In 2013 real GDP is 275. Therefore, using 2014, real GDP goes from 2075 to 300 from 2013 to 2014. 275 to 300. Then what is the growth rate? Again, Growth rate is the percentage change. How much is the change? The change from 275 to 300. The change is 25. Change from what? Change from 275. Therefore, the growth rate is 9.1%. Alright, now here comes the problem. Remember, when we use 2013 as the base year, real GDP growth rate is 10.3%. But if we use 2014 as the base year, real GDP grows only by 9.1%. Which number is correct? Well, both are correct. Which number should we use? Well, we can use either one of them. But the problem is, again, if you use 2013 as the base year, you ignore 2014 prices. If you use 2014 as the base year, you ignore 2013 prices. Which year prices are more important? Well, who knows, right? So what can we do? If we want to take into account both 2013 and 2014 prices, what should we do? The answer is, how about take the average? That is, we take an average of 10.3% and 9.1% and get 9.7%. This is the new method of calculating real GDP, which is called chain-weighted GDP. That is, the chain-weighted GDP uses the prices of two adjacent years to calculate the real GDP growth rate. Remember, chain-weighted GDP, you calculate the growth rate first because you just take an average of these two numbers. Therefore, this chain-weighted GDP is exactly the method that the United States is using to calculate the real GDP. So now, let me explain it again, step by step. Say for example, we start in 2006. So step 1 is to use 2006 as the base year. Calculate real GDP growth rate from 2006 to 2007. And then use the adjacent year, that is 2007, as the base year. Do the same thing, calculate real GDP growth rate from 2006 to 2007. Then take an average. Now this average is the growth rate of the chain real GDP from 2006 to 2007. The next step, you use 2007 and 2008. So step 4 is to repeat the first 3 steps for 2007 and 2008. Then you will get 2007, 2008 growth rate. Step 1, 2, 3 will give you 2006, 2007 growth rate. The next one, repeat these 3 steps for 2008, 2009. Then you get 2008 to 2009 growth rate. The next, 2009 and 2010. The next, 2010 and 2011. This is the graph on your textbook. So what is that? Look at this. So ignore these numbers. So step 1, using 2006 as the base year, calculate the growth rate. Step 2, using 2007 as the base year, calculate the growth rate. Then step 3, take an average. The average is the growth rate from 2006 to 2007. And say, for example, that number is 7%. And then use 2007 as the base year to calculate the growth rate from 2007 to 2008. And then use 2008 as the base year to calculate the growth rate from 2007 to 2008. And then take an average. The answer is 5%. So you repeat these steps you get all those growth rates. Then you pick a base year. You pick a base year. Say, for example, you put 2009 as the base year. And remember, in the base year, nominal GDP is equal to real GDP. Therefore, in 2009, if nominal GDP is 125, then real GDP is also 125. And then in the previous steps, you know that the growth rate from 2009 to 2010 is 4%. Then you can calculate the real GDP in 2010. Why? 125 grow by 4%. So grow by how much? The answer is 5. So 125 grow by 5. Then what is the new number? 130. Therefore, the growth rate, the real GDP in 2010 is 130. That's exactly how these numbers are from. Okay, that is how we calculate real GDP today. Okay, in the quizzes or in the exams, if we don't specify the chain-weighted GDP, then we are asking the old method to calculate the real GDP because it is more straightforward. Now, so we have introduced real GDP as a measure of the quantity of aggregate market. It is not the measure because there is no the measure of quantity of the aggregate market. So there are some problems of real GDP as a measure of economic welfare. The first one is, remember, household production is not included in the calculation of GDP because it does not have a market value. So when I'm teaching math to my daughter at my home, I am contributing to the economy because I'm accumulating my daughter's human capital. However, my contribution to the economy is not included in the calculation of GDP. Therefore, if you take household production into account, GDP undervalues this country, this economy's production. Second, again, underground economic activities are not included in the calculation of GDP because they don't have the activities do not have a market value that the government can use to calculate GDP. Number 3, do you like leisure time? Yes, but when you are calculating nominal GDP, you are calculating production only. You ignore the leisure time. Say for example, now we work 8 hours per day, 5 days a week. But your grandpa worked 8 hours per day, 6 days per week. So you have more leisure time than your grandpa, but it is now reflected in the calculation of GDP. Number 4, the environmental quality. Okay, the Chinese economy is growing like crazy. But do you like to live in China? Well, the air pollution is very, very bad. But it is not reflected in nominal GDP. Therefore, even though their real GDP is growing like crazy, but the economic welfare is overvalued by their real GDP. So nominal GDP, real GDP, is not a perfect measure of the quantity of the aggregate market, but it may be the best available and the most popular one. You can see that on the newspapers, internet, all over the place. Another problem of using real GDP as for the comparison of economic welfare is when you are comparing the economic welfare in China and in the United States. That is the international comparison. So who has a higher real GDP? Sweden or India? The answer is India must have a higher real GDP measure. Why? Because India is huge. But will you say the economic welfare in India is better than the economic welfare in Sweden? No. So in order to do a fair comparison, you have to calculate per capita real GDP. That is, you use the total real GDP divided by the population. Another problem of international comparison is real GDP is calculated in different currencies in different countries. Therefore, if you want to compare the economic welfare in 2 different countries, you have to convert their real GDP to convert the real GDP into the same currency unit. Also, you have to use the same prices for the same goods to value the goods and services in each countries in order to do a fair comparison.